Hot seat this evening, Kimon Boyiatjis from Trident. Kimon, appreciate your time. How are you handling the volatility that we're seeing in the gold price at the moment, hitting that new all-time high of $1,911 an ounce last week, then going back below that $1,800 an ounce level, and now at the moment we're trading back above $1,800 an ounce. Kimon, has it been a roller coaster ride for you, or is the ultimate trend still just net positive?
It's been a great ride. Thank you, Bronwyn. As you know, we've been advocates of being at least 10% of a portfolio in physical gold. One of the reasons as well is that we view gold as a currency, and I always say, what would you prefer to have in your hand right now? $100, 100 euros, or 100 worth of gold? And I suggest that if we had to look 200 years into the future, most of us would prefer to have gold. And gold, I view as a currency hedge. It's a good diversification tool. We have been at what I think is an upweight limit, which is 10%. And at these kind of levels, we're happy to take some off the table. I don't like to tinker too much with asset allocation. As you know, I'm a strong advocate of having a good asset allocation diversification within a portfolio. And the minimum that I would ever hold in physical gold will be 5% and probably maximum 10%, where we're at now. And I do think it's time to take some money off the table, but rather on the fringes.
Kimon, just your views on gold. You mentioned it as a currency. Are there any other reasons why you are sticking to the gold thesis, even though you're taking some profits at the moment?
I've always been a great advocate of gold in a portfolio. I know it's not been the flavor of the month for the last 3 decades, but we've been, at least for the last couple of years, big bulls on gold, and I think there is a place for it in the portfolio. I always look at gold as an alternative currency, and I think with all the uncertainty surrounding where the dollar's going, where the euro's going, and where sterling's going, and those are currencies that we're not particularly fond of right now, and I think they will depreciate in value relative to others over time. For me, it's a much better alternative, and I prefer the physical gold purely because of that. When it comes to having gold mines, those are good for leverage, but I think therein lies too much volatility, and hence my preference for the physical. I also know, I mean, we've got, as you mentioned earlier on, we've got uncertainty surrounding nationalization, etc. So which gold mines do you hold? And I much prefer to hold the physical in my grubby little paws.
With growth prospects looking weaker globally, it's a theme that obviously we've been discussing for some time now on the news desk. How is that affecting your asset allocation?
We were always wary of the 3rd and 4th quarters of this year. As you know, we've been, at least 6 months ago, we did say that we didn't think there would be much follow through in the global economy, despite what the central bankers were trying to do. And with all the liquidity that they've pumped into the market, and again, I do stress that that's really what got us into this mess in the first place. They're utilizing the same kind of medicine to try and cure the ailment that they actually created. But having said that, we were always a little concerned with growth prospects going forward. I think it's going to be bumpy. And actually the next move, as we all know, with central banks globally, is certainly not going to be a reduction in interest rates. Interest rates are far too low globally, and I do think we're going to have a bit more uncertainty. I'm sure, and I do believe that there are pockets of value when it comes to certain companies, and I do suggest that analysts who do their homework should be looking at companies with higher dividend flow, etc. And I would be putting my toe in the market, but not to a great extent. We've still got an asset allocation between 40 and 45% to equities, which I think is it's, according to the market, is low, but in my opinion, that's where we should be. I don't think we should be extending our exposure to that sector of the market yet.
Kimon, you mentioned low interest rates and we should be looking for dividend-paying stocks. Are there any sectors or specific shares that you like in that area?
Yes, I like cash-generative companies, and if I look at it on a global basis, we can get access through our market to BATS. I think BATS is a great company. The morals of holding cigarette companies, I'm sure that best left up to the individual investor, but that's the kind of company I like. I like Nestle. I think a food sector is certainly going to be a sector that I do believe can still be cash generative. I think prices are still accelerating there. Locally, I like some of the telecoms, MTN, Vodacom. Those are companies that are going to be paying good divvies. And I do think, despite the fact that we've got a huge penetration into the cellular market in South Africa, those companies are still going to be holding their own.
Touching on global banks, it's also one of the themes that you've thrown forward to in our discussion piece. What is the attraction for you where global banks are concerned, especially in light of Christine Lagarde, new head of the IMF, saying that we need to see the banks in Europe specifically recapitalized pretty much across the board?
As you know, that's the sector that we've been the most underweight for the last couple of years. I'm not in a big rush to go piling into banks right now. I do think there will be some banks that do offer value, but I've always believed, and this is not just a recent thing, over the last, I've been in the market almost, well, over 2.5 decades, and I was always wary of banks because of the gearing effect within banks. And I think not too many people truly understand the impact that a reduction in the capital base can have on a bank. And I am still wary of what may happen and certain losses that they may incur. I do believe that the majority of what was off balance sheet is on balance sheet, but somehow I do believe that there's a little bit extra to come. I'm not too comfortable holding the banks right now. I do agree with her, but at the end of the day, it's not a sector that I feel entirely comfortable with right now. So
staying away from global banks, in other words?
Yes, I'm sure there may be 1 or 2 exceptions out there that are well capitalized and have actually realistically priced their assets. I still have a bit of a problem with some of the banks. I think even locally, the way they price their assets, so if you look at the asset liability mix, have all the local South African banks actually priced their property holdings to market, or if they've got them in their portfolios still at book value, which I think is something that we should delve into a little deeper.
Perhaps we can also delve into the Forex situation at this stage. We were chatting to Bridget Taylor from Nedbank Capital just a while ago, and looking at the developed world currencies, the message coming across loud and clear from her territory saying stay away from developed world currencies, investigate emerging market currencies, and perhaps the South African rand is one of the best places to be.
Again, we've been bullish on the rand, as you know. I do think the sell-off we saw recently was part of the concerted effort by some of the large central banks globally to actually weaken the yen and weaken the Swiss franc. And that did have a negative impact on emerging market currencies, including our own. We're back below 7 rand to the dollar. I do continue to believe that relative to the euro, the dollar and sterling, the rand will perform very well. And I think if we have a look at the Canadian dollar, we look at the Aussie dollar and New Zealand dollar, we will fare as those currencies do fare. We're commodity-based economies, all 4 of those countries that I've mentioned, and I do believe that we will see at least the rand hold its own against all of those 3 majors, and possibly, in my opinion, quite aggressively outperform them.
Kimon, you mentioned the Canadian dollar, the Aussie dollar and South Africa, all of them commodity producing countries. How do you feel about commodity stocks in this environment? Are they too cyclical for you, or well, what is your feeling there?
No, I like the cyclical nature of those stocks. I do think to be in a diversified miner, I wouldn't be very overweight. I'd like to pick one of them, maybe Billiton, because it's got a diverse range of what it does hold in its portfolio, particularly oil. So I do think that you must have one of those stocks in your portfolio, and that's the one I'm probably the most comfortable with, and it's arguably the one I'm almost in a way very glad that they haven't managed to do any deals and spend money over the past couple of years. I do think that there's still going to be pressure on the board to do so, but it's the company that I do believe will do particularly well, and it's again, I think dividend-wise, it'll be paying fairly reasonable dividends, as well as the fact that it does have quite a bit of cash on the balance sheet.
Kimon, thank you very much for your time. Kimon Boyiatjis from Trident.